Hi, everyone. This is Jelena Ogilvie, Partner and Director of Business Development here at Principal Wealth Partners, inviting you to an extremely insightful discussion with Andrew Opdyke, who is a senior economist and a member of the First Trust economics team that Bloomberg has ranked as one of the top forecasters of the U.S. economy over the past several years. Cogent's 2017 survey of advisors has also rated this team as number one for the most read and shared by financial advisors with colleagues or clients. At First Trust, Andrew is responsible for analyzing economic indicators, writing economic commentaries, and producing articles on the First Trust Economics blog. Andrew also provides research and analysis to their chief economist, Brian Westbury, one of the most sought-after speakers in the industry. Andrew received an MBA from Northwestern University's Kellogg Graduate School of Management, and he holds the Chartered Financial Analyst designation. In this 45-minute discussion, Andrew will provide their outlook on the economic path to growth, despite the fact that we're not where we all thought we would be post-pandemic. He addresses some topical concerns around inflation, debt, and potential tax changes. And finally, reasons for optimism in equities and the areas of opportunity going forward. I hope you enjoy. Well, thanks, Andrew. We really appreciate your time. I have to tell you that we value the resources and opinions of you and your colleagues at First Trust. So we're thrilled to have you here today. And I understand that you have been traveling a lot this year, despite the fact that most have not entered an airport yet. So how many cities have you been in?
So far, 66 cities so far this year. I've traveled to about 30 states, East Coast, West Coast, North, South.
Holy cow. I don't even know if I could list 66 cities right now. So that's good for you. I also know you have two kids, and I wanted to check with you on the your time at home in the pandemic. If you can answer, just so everyone gets to know you, three questions I have. If you can answer with one word. What was your favorite activity to do in the pandemic with your kids?
Swim.
Oh, okay. No follow-up questions. All right. Question number two. What was your favorite cooking activity with them? You said you guys love to eat.
Oh, pasta. We made pasta at home.
Love it. That wasn't one word, but I'll let you go. And then the third one is favorite show.
Right now, Ted Lasso.
Okay. I've heard that from people. Great.
It's great. Check it out.
All right. Well, thank you. So, let me kick this off. And we have, we're sitting here now in entering the fourth quarter, my goodness, of 2021. So we have now seen the depths of a pandemic and recession. We saw an equally record-breaking market recovery, economic recovery. And quite frankly, I think everyone thought by now we would be out of this, and we're just not there. So there were a lot of predictions coming into 2021 that probably haven't really come into fruition. If you can start with a broad perspective of kind of where we are, because the markets continue to go in an all-time high. There has been very little volatility, although we've seen a little bit more now, and there's more noise coming. So if you can start with the economic perspective, that would be fantastic.
Absolutely. Yeah. And, it is kind of incredible that we're already here going into the fourth quarter of the year. So much has happened. So many things that people thought would be through by now are not. But then a lot of things that we didn't expect would accelerate at this pace have taken place. I'm going to do this. I'm going to share a couple slides with you. I want to talk about what we see taking place when we dig beneath the surface. And this is one of the hardest parts from an economic perspective, is that if you turn on the TV, if you turn on the radio, if you open up the newspaper, you hear one side of things. But when you dig into the data, what you find is that they kind of cherry pick certain numbers to make exciting headlines. But I think it misconstrues what's taking place in the world around us. And as I've traveled across the country, there's some things that we see taking place that I wish were getting more focused. And I want to start here with retail sales. I want to start with consumption. What are consumers doing? What has their activity looked like through the last 12, 18 months? And I want to start off by first noting how different it is from the financial crisis. We go back to 2007, 2008, 2009. We were growing at a trend before the downturn. We were growing at a trend after the downturn. But because of that slowdown in activity, we saw about a 2-year period, 2 years where it took us to get back and start setting new highs, start getting back to where we were pre-recession. This time, that happened in a matter of months. And you can see these gray lines that are on the screen. This is recession shading. There's a group called the National Bureau of Economic Research. They're an absolute hoot to hang out with. But what they're charged with is identifying when did recessions start and end. And they tell us this information about a year after it happened. They're not the most timely group, but they have now officially dated the COVID recession. It was 2 months long. It was March and April of 2020. It is going down in the history books as the shortest recession in U.S. history. And we could see this in the data because you could see consumption, you could see employment, you could see business activity turning starting in May, and essentially it's been largely moving higher since. That means it moved higher through the third quarter of last year when we were seeing cases rise in Florida and California and Texas, Arizona. It rose through the fourth quarter, that fourth quarter where we saw cases rising essentially across the country. It's continued to rise this year through vaccination starting and case numbers falling, through the Delta rise again. So consumption, what consumers have been doing, has been relatively strong. We've adapted in how we're interacting with businesses, interacting with each other. So let's take a look at this. Let me start off by noting this number started to moderate a little bit of late, but we stand 18% above pre-COVID levels. If we just extend this trend out, let's assume for a minute that COVID had never happened. Well, if COVID had never happened and we kept growing at pace, it would have been another 2, 3, 4 years for us to reach the spending levels that we're at today. So how did this happen? How did we accelerate in the face of a pandemic? Well, part of it is we threw a lot of money at the problem. And you don't need a PhD in economics to know that if you give people money, they'll spend it. So they took the money, they took about a third of it, used it to buy things that showed up here in retail sales. They took about a third of it and they used it to pay down debt. Credit card debt in the United States is down about $100 billion in the last year. And they took the last third and they put it away into accounts, checking accounts, savings accounts. We'll talk about that more in a little bit because it has some ramifications on things like inflation and things like the sustainability of the recovery as we move forward. But we've seen some amazing activity. Now, it's transitioned. Here, kind of right about here is the end of last year. We were up slightly at the end of last year. Now, at the end of last year, I was starting to travel, and I'll tell you, I was seeing these numbers, and I said, yeah, but when I go to downtowns, when I'm in Chicago, San Francisco, whether I'm in New Haven, New York, New Jersey, whether I'm down in Houston, the downtowns didn't look like they were back, and it's because they weren't. When we start digging beneath the details, we see different areas were impacted in different ways. So for example, restaurants and bars. Okay, this is emblematic too of your mom and pop shops, these types of businesses that rely on face-to-face, in-person activity, right? They didn't have next day shipping. They didn't have curbside pickup, many of them at the beginning of the pandemic. This is a group that really got hit hard. And through last year, by the end of last year, some of the activity had recovered, but they were still down 15, 20%. Now, this has been a leader this year, right? And I would kind of call this the jailbreak mentality. What happens when somebody gets out of jail? I don't know this personally, but I hear you want to get a cheeseburger. You want to get something, do something that you couldn't do when you were in there. And this year, with the vaccination rates and with some easing of restrictions, we've seen people getting back to restaurants. Right? They're going out with family. They're going out with friends. We've seen people taking vacations this year. We've seen a return back to areas that lagged last year. Now, as we move away from the downtowns, if we start to step back from downtowns, we start to see how the COVID virus and the shutdowns, the shelter in place, impacted different kind of areas in different ways. So let's jump to the general merchandise stores, right? We're moving off of Main Street. We're getting out a little bit. We're getting to the Costco's, the Walmarts of the world. You can see a big jump at the very beginning, okay? You all remember this. This is the great toilet paper run of 2020, right? It was toilet paper. It was water bottles. It was hand sanitizers. My parents are still working through their stock. They still have a couple sets of toilet paper in their garages. And it was followed right after by this pullback period. And this was April. This is when people were like, I'm not sure if I can go out. I'm not sure what the rules are. I mean, this was a new, unique experience for our lifetimes. And so as we tried to figure out what is the next month or 2 or 3, nobody knew how long that timeline was going to be. As we figured things out, we kind of pulled back, and then we realized, hey, we can go grocery shopping. We can do these things. Now, this year, as spending came through again, we saw a pickup even extending out to these areas of the markets, but they were less volatile because they had an easier time kind of adapting to the COVID environment. These tend to be large companies. The Costco's, the Walmarts of the world did have the capacity very quickly to shift to curbside pickup and things like that. Now, this too was not an area that was up 18% since COVID started. This was another area where things were relatively flat from pre-COVID. What we saw last year, the growth last year was led as we moved from the outside inside and the inside online. We took a trend that was taking place. We were moving towards purchases online, right? We were moving towards this kind of digital world pre-COVID, and it got amplified. We saw years worth of adoption, right? If we extend this line out again, we saw years worth of adoption shifted into a matter of a few months. Now, I look at this and think it's incredible we were able to do this, right? Imagine if COVID had happened back in 2000, right? You guys remember Y2K? Y2K, and this is when we weren't sure what was going to happen when the little 99 went to the 00 in the bottom corner of the computer and CNN was running stories. Could we see the U.S. missile system fire off? Well, back in the year 2000, we had no iPhones. We had no iPads. We didn't have the Zooms and the WebExes of the world. Maybe some high-tech or government agencies had some ability to do kind of video conferencing, but it was not widespread. If COVID had happened back then, our ability to adapt to that environment, to shift, to make the transition we did last year, it would have looked very different during that recovery. But over the last 20 years, we got the iPhone, we got the iPad. We now walk around with pocket computers that are stronger than anything the world leaders had back at Y2K. And because of the technological, entrepreneurial innovations that have taken place over the last 20, 25 years, it put us in the position to do what we did last year. It's a miraculous thing when you stop and think about it. Now, the transition back towards downtowns, the transition back outside that's been leading activity this year, this has not been without its hiccups, right? And we see this when we go to restaurants. We see this when we go to stores. I still, almost everywhere I go, you walk by a restaurant and in the door, as you're walking in, you see a help wanted sign, right? There's been difficulties. We're kind of in this environment right now where demand is incredibly high. And now we're trying to figure out, how do we fill that? How do we get the supply? The demand is there. The spending is 18% above pre-COVID levels, but we are not back to even on the employment front. Now, there's questions. This is one of the biggest questions in economics today, is what has put us in this position where we can't get back to these pre-COVID levels of employment. Why can't we refill these jobs? Job openings today are at all-time record high levels. We've never seen this many job openings. Now, there's different arguments on this. Some of it has to do with childcare. Some of it has to do with the payment of additional benefits and the extension of unemployment. Some of this has to do with, the fact that we had the Delta and COVID cases rose and people were concerned. I think we're really going to get all of these tested here over the next few months, because as of September 6th, as of Labor Day, of all the days they could choose to end unemployment benefits, they chose to do it on Labor Day. We saw the ending of the unemployment benefits. We have kids now back in school. My wife is a fourth grade teacher. Her class is back. Every student is in the classroom. So that should bring some easing on the child care side. And then case numbers right now, the Delta cases in the United States are declining. I think we're going to see how much impact this has in terms of bringing people back into the labor market, back to employment. It may take a month or 2 or 3 to really show up in the numbers. They have to go out. They have to look for jobs. They go through the application process. Then the jobs start. We may not see it in the short-term employment numbers, but I think we're going to get there. Now, we have to take a step back and say, how much impact was there last year when we shut down, did the shelter in place? From an employment standpoint, we lost 22.4 million jobs in 2 months. That is a near tripling of the job losses during the financial crisis. This was massive. We essentially, in 2 months, canceled out 10 years of job gains from the bottoming of the financial crisis all the way up to February of 2020, when the U.S. unemployment rate was around the lowest levels we'd seen since the late 1960s. And it didn't matter your age. It didn't matter your education level. every area of the employment market was seeing historically strong performance, and then this hit. Okay, so even with relatively strong return to activity here, back in the financial crisis, it took 2 years to get half the jobs back. That happened much faster this time. In fact, we're on track right now to see 7 million jobs added in 2021 alone. This would be the single best calendar year for job gains. We add that onto the job gains that took place from May until the end of last year. That was 7 million jobs. That means that over this period, right, roughly 19, 20 months, we will have brought back 19.3 million jobs. That is a very large number. It is significantly faster than what we did during the financial crisis. But then you have to look at the fact that we lost 22.4, which means that even with a record year, we're still going to be down.
Right.
We're still going to be down jobs. And not just the fact that we're still going to be down 3.1 million from where we were when all this started, but these numbers would have continued to rise, right? We've added more people to the population. We would have continued to add jobs. I would say right now, even if we hit 7 million this year, we're still going to be about 5 million jobs down from the trend we would have otherwise been on. To me, that's the full economic recovery. Now, this number is also incredibly important because we got the Federal Reserve. And the Federal Reserve said, look, we don't want to raise interest rates in this type of environment. We'll talk about inflation in a moment. That's one part of their mandate. But the other part is this employment. They say, look, we have substantial, this is their terming, substantial further progress to make on the employment market before we're comfortable lifting rates and starting to bring policy back towards more normal levels. And this is going to take time. Some of these jobs, it's because the businesses don't exist. Their doors closed during COVID, and yes, we're going to see new restaurants fill empty spots on our main streets, and we're going to see new retailers come in and open up shop, but it takes time. And so while we're in that process for the time being, through the remainder of 2021 and at least through the first half of 2022, I think this is going to be the key thing that is keeping the Fed on hold. Now, they're getting asked a lot of questions of late about the inflation side of the economy. We go to the grocery store. We go to the gas station. It seems like no matter where you go, we just got news that Dollar Tree is raising their prices on some things above $1. They're breaking the buck because of inflation. And so this is showing up across a large number of areas. Now, the Fed says, yeah, but it's because of this, right? When these jobs come back, that's going to ease the supply chain. That's going to bring things back into flow. We'll see the inflation decline. They're calling it transient. Now, as an economist, I say, hold on. That's one part of the equation, but that's not the only thing we did last year. Last year, we added significant money to the system, and we did it in a way that we haven't done in roughly 80 years. Last year, we did the PPP payments. Last year, we did direct checks to consumers. We did the additional unemployment benefits. We added literally trillions of dollars, and we gave it to individuals and to businesses. Now, you go back to the financial crisis, the Fed did extraordinary action back then, quantitative easing, and it made tons of headlines. But at the end of the day, that was the Federal Reserve buying treasuries from banks, giving them money, reserves in its place, but the banks didn't lend it. This number, M2, this is checking accounts, savings accounts, money market funds, currency in circulation. I would think of this as the money that consumers and businesses hold with the banks. And this number has skyrocketed. Now, we're looking at the year-over-year percent change. The M2 is not declining. It's just not growing as rapidly as it did before. This number is up 33% since February of last year. Now, I said this is the first time we've done this in nearly 80 years. We have grown at this magnitude one other time in the last century. That was back in 1942, 1943, as we were financing World War II, right? We brought massive money into the system. There was inflationary impacts that flowed on from that. But here's how I want to think about the impact from money coming into the system. Okay, let's step back for a moment, and we're going to create an imaginary economy. This imaginary economy has two things. It's got 10 $1 bills. It's got $10, and then it's got 10 apples. Okay, and I'm not a great artist, but there's my apple. Okay,
better than mine.
And so in this type of economy, right, with $10 and 10 apples, how much should every apple cost? Well, each apple should cost $1. We should sell out of all of the apples. The market clears. There's your price. Now what we're going to do is we're going to add money to the system. We're going to take that additional money. We'll do like we did last year. Let's move it to $13. We move it up by 30%. We have 13, but we still have 10 apples. Okay. Now how much do they cost? Well, now because there's more money chasing the same amount of goods, the price rises. It goes up to $1.30. This is, if you go back, if you did not throw away, burn your economics textbooks after you were forced to take that class, and I understand if you did, if you go back, this is essentially the definition of what causes inflation. More money chasing the same number or fewer goods. So when the money came into the system, that is inflationary. Now, that's not all that happened last year. Instead of creating 10 apples, we created less. We lost the employment. There was social distancing in the apple orchard. Let's say they created 5. Okay, so now we've got 5 apples. We still have $13 in the system. Well, I'm not going to make you do the math, but it equals out to $2.60. Okay, so what we've had is this shift take place. We've seen inflation come from 2 different sources. One was supply chain constraints. It was the fact that we had less things being created. The other side comes from new money in the system. And Powell says, yeah, but we're going to get from 5 back to 10. This is what happens as the supply chain eases. We get back to where we were from a production standpoint. And I say, you're correct, but that brings us back to $1.30, not to $1. Because the easing of the supply chain does absolutely nothing to remove money from the system. So that money that entered in, this M2 effect, that yes, a lot of it right now is sitting in checking accounts, it's sitting in savings accounts because there was uncertainty. People increased that cushion. As that money, as confidence returns, I think that money is going to continue to come out into the system. And this number that's up over 30%, the way that you could offset that is by increasing production by roughly 30%. If you produce 13 apples and $13, then these numbers even out. But where are we on that side? I'm going to skip this one. I want to go here. GDP is up 0.8%. Okay, so the money supply is up 33%. GDP production of the United States is up 0.8%. You can see there's a mismatch here. Now, I would love to see this number grow by 30%. Right now, in 2021, we are having a historically strong year for economic growth. We are on track to see the U.S. economy grow 5-6%. And that's inflation adjusted. That's pure output. Now, that would be the single best year of economic growth since 1984. This is very strong growth, historically strong, but it means that even at historically strong pace, it's going to take years for output to come up and meet the money supply. I think the inflation pressures are going to remain here for the next few years as we really go through this normalization process. Now, the fact that we're up 0.8% in an environment where in the second quarter of this year, which is the latest data we have from a GDP perspective, that output level came with the U.S. economy down 7 million workers from the previous high. We've become more productive. We've implemented new and better technologies. We have the capacity to grow at a faster pace. And when you add in the fact that we have those 3.1 plus million jobs to get back to normal, I think employment's going to rise above trend. I think business investment is going to continue to rise above trend. And I think we're going to continue to see government spending coming through at above trend levels. We're going to get the vote on the infrastructure bill. I don't know on the budget reconciliation, that larger package that could range anywhere from $1.5 to $3.5 trillion. But there's already $900 billion of the $1.9 trillion package that got approved back in March. $900 billion of that is allocated to next year and beyond. And with an infrastructure hitting next year and beyond, that tailwind effect from the spending is also, I think, going to keep activity elevated in 2022. Now, one of the biggest questions I usually get here is, if economic growth is just moderately above, 0.8% above where we were when all of this started, how are the markets up where they're at? And I think that's a fantastic question. Now, I want to remind you that when we moved last year from the outside inside, the inside online, we moved who we were buying from towards companies that tended to be national companies that had the supply chain logistics to meet us where we were. They brought the store to us. So we shifted spending in that direction. But for me, I want to step back from what happened last year. I want to step back and say, what moves markets over time? So how do we think about this, whether we're in a recession, whether we're in a recovery, whether it's the financial crisis, or whether it's what happened last year with COVID? What is the framework we can use to think about market valuations? And here's the framework that I use. There are two key components that I look at for market movements over time. I look at interest rates, the cost of borrowing to invest in people, in products, in projects, and then I look at the earnings that get created from that investment, the returns that we get as buyers, investors, part owners of these companies. Now, on the interest rate side, the cost of borrowing has been held down massively by a Fed who's keeping the federal funds rate, the base rate for the U.S. economy, at zero. There are some inflation pressures that are pushing this a little bit higher, but it remains anchored near some of the lowest levels we've seen in history. And we saw massive borrowing activity from companies taking advantage of that environment last year because they saw the activity turning, just like the data showed back in May, June, July of last year. And they said, we need to be prepared. We need the balance sheet strength to invest as we emerge from that. Now, this means if you have saved for retirement and now you're putting that money to work in bonds, in fixed income, it's an incredibly difficult environment, right? It means as these rates get anchored down, pulled down, you're being less compensated for taking on the risk of lending to companies, lending to municipalities. But from an equity standpoint, this is an unabashed positive. This is a positive feature. Their cost of investment is low, and then we go to earnings. And on the earnings side, we talked about this with employment. We looked at this with retail sales, how different this time looks relative to the last time. Well, last time it took us 5 years. It was 5 years to see earnings come back and set a new high on the S&P 500. We had the recovery. You can see the impacts of the tax cuts from 2017 to 2018. We had COVID, which brought earnings back down, but it brought us basically back down to where we were before the tax cuts. And this number I'm about to show you, this is not my forecast. I go to Bloomberg. Bloomberg aggregates the forecast across banks, across analysts. So this is the consensus number from investment professionals. Here's the outlook for this year and next. The earnings growth right now is incredibly strong. These companies have pricing power. Inflation is there, but these companies have been able to pass it along because people aren't asking how much things cost. They're asking if they can get it. The other important thing that's happening here is, like we're seeing with the economy, we're seeing a broadening out. Last year, we had a handful of tech companies, a handful of companies like the Amazons of the world that really led the charge when the majority of companies were still lagging behind, still hadn't caught up to where they were pre-COVID. Now we're seeing the broadening out of the U.S. economy, the broadening out of the U.S. markets, and for me, that is a very healthy, positive thing. So we take these numbers, we put them into a model
Andrew?
that we talk about. Yep, go ahead.
Can I ask a quick question on that for the last two slides? Because there is so much
Sure.
concern that the equity markets are at an all-time high. We're having this conversation over and over again. So
Sure.
basically the last two slides, what I think you're trying to summarize is that the equity market relative to the bond market is still very attractive.
Yes.
And the earnings continue to be very powerful. In fact, even more record breaking if these numbers are accurate, which lends to good return in the markets over time.
Yep.
Okay.
Yep, absolutely. Those are the fundamentals. On the interest rate side, I mean, people have been saying there's the TINA principle. There is no alternative, right? If you're not in the markets, where else are you going to go? People have now been calling this the TRINA principle. There really is no alternative. And you could add a couple extra A's on here at the end. There really is no alternative anywhere at all. You go international, you look across sectors, it's incredibly tight right now. So it is pushing money that's looking for returns. It's pushing it in this direction. And this is the fundamental driver over time. The real earnings, that is what propels us forward over time. Now we look at this relationship. We take these two components, interest rates and earnings. And at times, right, one of these can move higher. We had higher inflation. We had higher interest rates in the late 60s going into the 70s into the early 80s. At times, earnings run up. But we want to say, how do these two move together through history? How do they move together over time? So that's what our model does. It takes this comparison. It takes interest rates, earnings, and the market movement. And this blue line is, what has that historical average been over time? How have markets moved historically based on these fundamentals? Now you'll see sometimes the markets get ahead of themselves, but they always come back to meet the math. Math wins over time. Sometimes fear and uncertainty run high. They come back and meet the math. our math right now says that based on earnings that we have through the second quarter, we don't have the third quarter, we don't have the fourth quarter, and we're not pricing in anything for earnings growth next year, strictly with what we've seen so far and using a higher interest rate. So these are both conservative inputs to this model. It gives us a fair market value of 6,100 on the S&P. Now, you can see these gaps can persist for periods of time. It doesn't mean that the S&P is going to 6,100 this month, this year, in the next 12 to 18 months, but it tells us the markets, from our perspective, remain undervalued with an incredibly accommodative Fed, keeping interest rates, keeping the cost of investment low, and with earnings strength, if that continues to flow through, those are certainly going to be contributing factors that are justifying a higher multiple on the markets. Now, this is the last slide. I do not expect we're going to get to 6,100, but our target for this year is at 5,000 on the S&P. Is this a magic number? Are we going to hit it on December 31st, January 1st? No. This is our best guess based on the factors that we're still going to hit this year. We've got the debt ceiling debate, which is happening right now. We've got what's going on with the budget reconciliation debate. We're going to have questions on what's going to happen with tax reform. We've got questions on the infrastructure bill. Pricing in the volatility, the uncertainty that comes with that, this is our best estimate of where we think the market could move to by the end of this year. But it's driven by fundamentals. We think interest rates are going to end the year in the 1.5% to 2% range. Inflation this year is probably going to be closer to 5 to 6%, but we're expecting it's going to remain in this 3 to 4% range here over the next few years. It's really being driven, though, by real economic activity. Real returns, more hands coming back to work, more hands producing. The demand is there, and it's the global recovery. As you reach beyond the U.S., as you look and see the emergence, the developed Europe is trailing just a little behind us. The emerging markets are still in the very early stages of coming out of COVID. As the world comes back, I think we're going to see some sustained momentum behind it. So that's where I see us standing today. Those are the fundamentals that we are paying attention to. Quite honestly, I turn off the TV. I'm going to stick with the math because I think that the math wins over time. So with that, why don't I pass things back?
Oh, great. Thank you so much, Andrew, for all those comments. And I'd love to ask a follow-up question to what you just recently addressed in terms of the views for year end. You mentioned the volatility, and it's so interesting to see that we really have not seen volatility. Historically, the market drops 5% 3 times a year. I don't even think we've hit that point yet. I know we're pretty close over the last week or two as we record this, but when you think of the noise that's out there, do you all foresee that volatility changing going forward?
Yeah. We tend to see about a 10% correction once every year. We haven't seen that in the past year. So some people would say we're due for a correction. I would not be at all surprised if we see one. Part of that is the emotions for all this. As the numbers rise up and as we reach, again, year end, there's going to be a lot of focus on, are we about to see a change in tax rates on January 1? And people are going to be thinking about, how does that impact their investments? How does that impact their expectations for growth and what they're going to be doing in the years ahead? This is going to be that time of the year where some of that's going to bubble up. If we get a 10% correction, my first question is going to be, is that based on the fundamentals or is it based on emotions? And if it's based on emotions, you have this disconnect between what something's worth and what something costs, and that's where we look for opportunity. So quite honestly, volatility is the price we pay to make money in the markets over time. Uncertainty is part and parcel to investment. That's why we have these processes to work over time. I can't time it, but you're going to be rewarded for time in the market rather than timing the market.
Right. No, and thank you for saying that, because we know the media loves to introduce the noise, and unfortunately, we're all in front of our TVs more than we probably have been, in years past. So I appreciate the focus on the fundamentals. And you mentioned the proposed tax reform. So we can't get off this webinar without talking about taxes. And I know you all are paying attention to some of the proposed changes, and we're learning more and more every day. So can you highlight maybe what you think are some of the key features that we should be focusing on, and what you think the implication may be on the markets?
Sure. So here's my base case scenario right now. What do we expect that we could see happen from a tax perspective. And it just happened to be that today, an article, a piece got released of Joe Manchin. He had signed an agreement with Chuck Schumer in the Senate saying, here's the things that he could get on board with a budget reconciliation package. And the budget reconciliation is the key piece that would bring with it the tax changes. So there's a few. One, corporate tax changes. Now, corporate tax rates were at 37, 38% from 1987, basically to 2017. In 2018, we dropped them from 35%, 35%, we dropped them down to 21, okay? The proposal leading into this was to move it from 21 to 28, move it halfway back.
Yeah.
But they're getting pushback from kind of it's Joe Manchin, it's Kristen Sinema out of Arizona. Manchin said, I could get on board with 25%. So it would be a partial return higher. Would that be a headwind factor for the markets? Yes, it would be a headwind factor to earnings, but some of that has already been priced in because people are expecting these tax changes are going to come through as they're making their forecasts into the future.
Right.
What else is on the agenda? So tax rates on corporations maybe go to 25. The personal tax rate. Top marginal tax rate went from 39.6 down to 37. The proposal is to bring it back to 39.6. I think we're going to see that. That's exactly where the top marginal tax rate was under the last 4 years of Obama. It was there under all 8 years of Clinton. That is not something that throws us into a recession. I don't think that has a significant market impact, but I do think it's going to come. The one that people have been asking a lot about in terms of the market impact is capital gains taxes, right? The long-term capital gains is at 20%. The proposal leading up to election from the Biden administration was, let's move it to the top marginal tax rate, 39.6%. They even floated a number of 42, 43% earlier in the year. They got tremendous pushback. The number they've been zeroing in on of late is to move the cap gains rate to about 25. Then you add in the Medicare, Medicaid tax. That brings it to an all-in tax rate of about 28%. This is exactly where things ended under the Reagan administration. And I think that's how they're going to position it. Can you argue with Reagan-era tax rates? So capital gains, they may move modestly higher. This could be another contributing factor on the volatility side. If capital gains rates are going to go up, and if they're going to go into effect as of January 1, 2022, people are going to do some of that selling, reorganizing activity at the end of this year in order to be prepared for that. Those are the three main pieces. There's been discussions on could they do something with inheritance taxes. There's been a proposal to eliminate the step-up basis on assets and tax capital gains at the times of inheritance. I do not think that's going to happen. It is incredibly complex to do from a logistical standpoint, but they may end up moving the exemption amount. Right now, for a couple, it's about $11.5 million is the exemption on inheritance. They may cut that number basically in half, go to $5.5 million. So would that have some impacts? Yes. Major market movements? I don't think so. But I think that if I had to put odds on it today, I'd say there's about a 60% chance that we do see these tax changes go into effect starting January 1 of next year.
Okay, great. And thank you for saying that, because the media is spending a lot of time on these potential changes and the possible negative impact to the stock market in particular. And we've done a lot of research here at Principal Wealth Partners, and we just candidly haven't seen that happen historically. So it sounds like you're suggesting the same.
Yeah, exactly.
Okay. No, great. Thank you. And what about the Federal Reserve, right? You talked about that a little while ago, and you mentioned that they're on hold based on unemployment. We did hear from them just a week or two ago, and it sounds like they're a little bit more hawkish. And there's a couple more members that are now talking about possibly raising rates next year. What's your perspective on how they lay this out? Because it doesn't mean they're going to do it, right?
Yeah, no, I think what they're talking about, they've been kind of slowly shifting forward. You go back to the beginning of this year, and it was nothing was going to happen in 2022, and it didn't look like anything was going to happen for raising rates in 2023, as inflation numbers have sustained higher than they anticipated, and some of the employment numbers have come back faster than they anticipated. Economic growth has moved a little bit faster than anticipated. That's kind of shifted forward the rate hike cycle. Now, of late, a lot of the focus for the Fed has been on the tapering. Right now, they're purchasing $90 billion of treasuries. They're purchasing $30 billion of mortgage-backed securities, and they're talking about starting to pare back that activity. I think that's completely justified. I do not believe that the $90 billion in treasury purchases is really doing anything to support the employment market. There's nobody sitting there saying, am I going to go back and find a job today? No, the Fed's buying $90 billion of treasuries. I'm going to wait for a little bit longer. So It's something that they can do that I won't. There's concerns about the taper tantrum. Back in 2013, the last time the Fed was doing QE and started to pull things back, people got nervous that it was going to cause this major fluctuation as a buyer from the bond market stepped out. We saw a huge run up in rates, about 100 basis points, about 1%, leading in before they even started reducing their purchases. And then as they did their purchase reductions, the interest rates actually declined along with them. I think we learned a lesson there. Yeah. I don't think we're going to see a full out taper tantrum. I think this is something they can do. And I think they're going to announce that the tapering, barring a terrible jobs report, the second Friday in October this year, it's on October 8th, we get the report for the month of September. If that report comes in even modestly good, I think we're going to see them pull the trigger in November. Now, the other thing that's been surrounding the Fed is there's been some internal issues at the Fed. There's been some trading activity from two Fed governors, or I shouldn't say Fed governors, Fed presidents. We had Rosengren and Kaplan, who both recently stepped down. And people have said, okay, this happened after the last meeting. Is that going to change this path moving forward? Right. I'm not expecting it to, because who's going to replace them? It's basically their deputies. It's the people who are right underneath them at these banks who are looking at the exact same research, who typically have been on the same wavelength thought process as who they were reporting to. So I don't think we're going to see a shifting in their dots. I don't think we're going to see a shifting in their outlook. We're going to see the change of names, but I think the path forward is the same path forward that we saw before these two stepped down.
Okay. And I think that's great, right? The markets don't like surprises from the Fed. And
no, right, exactly.
Yeah. Okay. No, great. Thank you. And what about kind of staying in line with that? You mentioned that we literally threw out a lot of money, over trillions in stimulus checks. And I've heard the concern from First Trust about debt overall. And, historically that hampers growth long-term. What's your view on where we are at this point with our debt issue? Yeah.
You know what, for that, let me bring up one more slide. Okay, yeah. This is a hidden slide. You get to see the hidden slide. So this slide here to me is the most important number when thinking about debt. This is the cost of servicing the debt. Let me go back. Let me get my pen here, turn back on. The cost of servicing the debt. So what we're looking at here, there's the amount of debt that's outstanding, right? And that amount of debt outstanding has risen. We issued trillions of new debt last year. But from a short-term kind of our ability to manage this, it's how much are we paying out in interest payments? How much does it cost us to service that debt load? So it's interest payments as a percent of GDP. If you think about this as an individual, it's kind of like, what's your mortgage payment as a percent of your income? All else equal, you have higher GDP, you have higher income, you can afford to have a more expensive house, you can afford those higher monthly payments. This tells us how much of production, every dollar produced in the U.S. economy, is going towards servicing the debt. So through 2020, through last year, this number was at 1.6%. 1.6%. So every dollar of production, 1.6 cents went towards servicing our debt costs. Now you can see in the 80s and the 90s, this number was at 3.1%. How is that? How is it that our debt rose, but our cost of servicing the debt has declined? Well, two components. One, GDP has risen over that time period. But really the most important factor in this is that interest rates have been declining essentially since the 1980s. And so not only does that mean that when we issue new debt, if we issue a new 10-year treasury today for new debt that we take on, we're doing that at 1.5%, 1.55, which is significantly lower than where we were at through the 80s and the 90s. But critically, when we roll over debt, if we have a 10-year treasury that we issued 10 years ago, back in 2011, and it comes due today, 10 years later, well, back then we were issuing it at 2.5%, 3%. Now we're issuing it at 1.5%. It's like we're perpetually refinancing, just like refinancing a house. If you refinance that mortgage as rates continue to move lower, your monthly payments are going to decline with that. Now it goes both ways. When rates are going down, this helps makes the debt service costs more manageable, and it's kept them in the lower end of the range that we've seen over the last 60 years. One of the biggest concerns is what happens as interest rates start to rise. As we get, if inflation persists, as the Fed starts raising rates, isn't this number going to move higher? And could we start reaching levels like this, getting above? The answer is we could get there. Yes, we could. That is the biggest reason why today, as we are in the recovery side of things, we need to be addressing this picture. We need to address the spending picture. On the tax side, We could tax every cent. We could take every dollar of earnings from this 400,000 plus group that they're proposing raising taxes on a lot of. You could take every cent of wealth, and it would be roughly enough to fund the government for 7 to 9 months. It wouldn't last for a year. And no country in the history of the world has ever taxed its way to sustainable prosperity. We have to get spending under control. Now, you can see in this chart that the timeline for these larger shifts, it happens in years and really in decades, not so much in a matter of months. So this is not something that's the debt load is not going to tear down the markets or tear down the economy in 2021 or 2022 or 2023. But to me, this is the biggest thing as we look out onto the horizon. And my 2 kids, my 4-year-old and my 6-year-old, who's going to be 7 here soon, I'm thinking about the bill that we're ringing up that they're going to be on the hook for. I really think we need to be focused on this, but in the short term, it is manageable.
Great. Thank you for that. And the visual is very helpful. So I love it. Last question. There's always a crystal ball question. So what are you all looking at as we finish this year and we start thinking about 22? Are there areas of the market that you're finding more opportunity in going forward? Would love to get your thought there.
Yeah, so what we're watching for is historically what does well as we're in this recovery phase. And what are those sectors? We've seen some major movements this year. You watch interest rates, and if interest rates was the only thing you had, the 10-year Treasury, you could have predicted, was tech doing well or was tech doing poorly? When interest rates were declining, when COVID fears were high, the tech companies started to boom, and those cyclical companies, the financials, the energies, the industrials, the materials, they started to lag. But now, as interest rates are once again rising, as we move further on in the recovery, I think the cyclicals that had a great run early in the year, I think they're going to take back over. So we're watching cyclicals. We're watching some of the smaller size, the small and medium sized companies. They take the worst of the brunt when we go through an event like we did last year. They have the hardest time accessing financing. As we move further into the recovery, the smaller companies are more concentrated too in those cyclical sectors. So I think through the year end, I like value a little bit more than growth. I like the medium and the smaller end of large cap. I think smaller size is going to do relatively well. And I think we're going to start to see, though it might not happen this year, it might happen into early next year, some of the international performance that's lagged. We are further along than a lot of the rest of the world. I think we're going to see some of that pick up as well, that global recovery. So that's what we're keeping an eye on from the market side. We're going to watch from an economic side what's happening with employment, what's happening with inflation, because the Fed moves are going to impact all of that, and we'll keep our pulse on it. We get to continue these conversations with the team on an ongoing basis. So if anything changes with that outlook, we'll be having that call.
No, that's great. Thank you. And we're always paying attention to your outlook. So we're watching. So I think what I'm hearing in summary is that the economy has room to grow, to continue to grow, but maybe not continuing at a 6% pace that we saw in this past year, or 6.5. Equities remain attractive despite continued all-time highs. Trina in fixed income, right? There really is no alternative. So that continues to be a challenge, not saying don't own it, but there's challenges there. And then increased volatility, if we see that come back, that is normal and not uncommon. So, okay.
Absolutely. Great summary.
Thank you so much for all of that insight. I'll let you take a breather now. And I know that one of your future 66 cities is coming out our way. So I look forward to meeting you in person. And again, we appreciate everything that First Trust has done for us, for our clients, not only from the resources and market perspective, but from the investments as well. So thank you to you and your team.
Thank you so much. And it was great talking with you today.